Welcome to Train to Invest Economic Forecast for the first quarter 2023. Let me first wish you a happy new year and trust you're doing well, and hopefully this session will give you some ideas of what is going to happen in 2023, the first quarter of 2023. We have presented today a phase 1 and phase 2. The phase 1 session will be available to the public, but the phase 2 will be limited to clients of Train to Invest. We begin with the disclaimer: suggested entry and exit points only suggestions based on available information, and these suggestions are both time sensitive and for educational purposes only. By continuing to watch this webcast, it is deemed that you have accepted the above. Toronto Stock Exchange, for those who do not understand or have not done any kind of investments in the stock exchange, the TSX is a symbol that is given to Toronto Stock Exchange. The exchange itself is the largest exchange in Canada. The exchange is fully electronic with more than 1,500 companies listed. All transactions in the TSX are conducted in Canadian dollars, and the TSX is owned by the TMX Group, which also owns Montreal Exchange, the TSX Venture Exchange, and the Canadian Derivatives Clearing Corporation. You don't have to worry about those. This is just given to you for your own information. For more details, obviously, you could go to the website www.tmx.com. Now, the question here is, what do you do with your savings? Okay, a lot of people have RSPs and TFSAs, RESPs, RFs, and so on. As you can see, these are just registered accounts that you most likely will have based on your income. And also the cash or non-registered account. A lot of people have trading accounts where they have cash, and some of them put them into GICs within the banks and hope to get a return. When we talk about registered accounts, many of you will be either using banks or independent brokers, usually mutual funds, who charge you a fee. Remember, you pay a huge fee called MER and other fees. Okay, that we will deal with that in a minute, but always remember that you are paying a fee for the services rendered. Now, you have investments in mutual funds. Many of them are within Canadian companies or financial institutions, but there are mutual funds that also extend take your money, invest in US companies, even European companies, or even some in Japan and Korea and so on and so forth. What you don't realize is there is a foreign exchange risk. You realize that when you go to the States, or if you go to buy US dollars, there's almost a 30% difference between Canadian dollars and the US dollar. So you are open to the foreign exchange risk. Your mutual fund companies don't usually explain to you what the risks or what the costs were. Now, having said that, we will look at the funds charge you a certain fee. And on top of that, they also have other kinds of fees, some of which are not very clear when you receive the statement. Now, this fee goes to the mutual funds regardless of performance, right? Whatever your fund has been providing for you, that's the return on investments, but you have to keep an eye on what is inflation. Often you get a return, maybe 4%. Let's say, for example, inflation is running at 7% according to the government, but I certainly believe that it's higher than that. So let's look around 8 or 9%, and that is what you're going to pay in terms of your costs. You have to add inflation as well. Now, what is your return on investments? You have to find those questions. The return on investments, also known as ROI. How much in fees did you pay the mutual fund company? What is the current rate of inflation? So if you look at inflation plus fund costs, did it beat the returns you got? If not, your portfolio is going to be destroyed. Unfortunately, many people don't pay attention, and I'm going to give you an example of a fund that you can easily go and Google for and see how that's been performing. I just picked one example, and so we have BMO Fund Select Equity Growth Portfolio, Series A to N, and they are supposedly objective is to provide you with exceptional long-term growth by investing primarily in higher risk mutual funds invested in equity securities. The fund may also invest directly in fixed income securities and cash or cash equivalents. The fundamental investment objectives may be changed with the approval of the majority of votes cast at meetings or whatever they do, right? You can go to this website, www.bmo.com, mutual funds, and look for that particular fund. So in investment grade, it's given a D. So what is your management expense ratio? That is the MER. I talked to you about fees in a few minutes earlier. It's 2.85%. Now, if you add inflation to that, another 7%, you're looking at 9.85% as your overall cost. Now, let's look at the return that this fund produced. The year-to-date return was a negative 18.11%. So, okay, for year-to-date, we will forgive them because we don't know what the full return would be. But let's look at the one-year annual return, 13.84%. Okay, and the three-year compound rate was 2.4%, and the five-year compounded rate return was 3.3%. So let's just look at the for computation's sake. Let's say you got 3.31%. If you deduct that from your cost, 9.8%, you're negative at 6.4%. So the return you're actually getting is negative. But let's look at the one-year annual return, negative 13.84%. Deduct 9.85% as your cost, you're down 23%, 24%. Your portfolio is destroyed, right? Your portfolio is totally destroyed if you're losing 23, 24%. And that is what nobody teaches you or nobody shows you. And we just wanted to highlight that for you so that you are familiar with what is it that you're investing in. All right, pay close attention to the expenses the fund charges you, as well as to the inflation rate. Now let's look at what happened during the post-COVID season. You had all kinds of headlines. As you see from the left-hand side, you will look at here. TSX plunges after trading halt as virus fees continues. Coronavirus TSX fees. December 3rd, 2021, Canadian stock market, McLean's, March the 19th, 2020, and so on and so forth. So you have the Globe and Mail, CTV, McLean's, the Global News, Bloomberg, all spreading fear. Why is this necessary? Sell everything and look for the nearest cave. They drive this kind of fear, apparently sells their magazines and newspapers and their information, but it does create a negative thought process for many investors. And so they are suggesting that kind of fear doesn't help. What are the main challenges for 2022 and now moving on to 2023? We looked at basically the China lockdown under COVID. Many factories in China were shut down, and that caused or created supply shortages, chain supplies problems around the world. And one typical example would be the medical side of things. You realize that there was shortage of flu medicine for children and so on and so forth. Those are one example of what a lockdown in China resulted. Then you had the Russian-Ukraine war. As you realized that the food shortage, food expenses, a food crisis was created because Ukraine is also a major supplier of food for Africa and Asia. And once you have that kind of supply removed from the equation, obviously the demand for all those products rose quite quickly, and therefore created or continues to create a food crisis. And then you have energy supplies. natural gas, which came from Russia mostly because of the foolishness of Germany, and they started depending on Russia for natural gas. And once the war started, the clampdown on gas being sent to Europe created energy crisis or natural gas shortage in Europe, particularly this winter, and people continue to suffer. Now, the central banks around the whole world are full of fear about recession because of the rate of inflation, and they start creating all kinds of interest rate hikes, causing the economy to stumble or at least slow down and create fear within investing or companies expanding their business productions. And then you have the China-Taiwan crisis. China continues to send warships and aircraft across the borders of Taiwan, creating real tension. And then you have North Korea firing all kinds of rockets across South Korea, including drones. And here is a very, very touchy challenge because you have North Korea also supplying equipment to Russia, uh, or all kinds of rockets and so on and so forth. So that could trigger Japan and the U.S. to get involved if South Korea is hit. And then we have, nobody talks about it, is the Iran-Israel potential war. Here, Iran is building a nuclear capability, and Israel says they would not allow that because the first thing the Iranians want to do is to build a rocket and shoot it at Israel. So there will be great tensions. Benjamin Netanyahu, the right-wing conservative, has come back into power, and he is strong in saying that they will not allow Iran to do that. So that's a major concern as well. And the other bigger challenge would be the U.S. border, where millions of people are starting to cross the border, and the border is not closed yet. So there is a great challenge, because what will happen if you have terrorists and those people who want to create chaos in the U.S. Come through that border? You could likely see all kinds of tensions happening there. We are waiting to see later this month, in January of 2023, when the Republicans take over Congress, what kind of strategy they will pursue. We'll have to look at that. Now, we want to talk to you about what is the TSX, or how is the TSX performed from 2019 to December, as you can see from the chart, December 21st, 2022. And here we have produced a chart where it shows you the timeline on the bottom and the rising or falling of the TSX itself. Now, for stocks, 1 point equals $1. So when you move 1 point, it's $1. So when you hear a stock has lost ground or gained X number of points, it is the same as saying the stock has lost or gained X number of dollars. So don't get too concerned about the points. What we are trying to look is trends. All right, let me go back to February of 2020, when the TSX was rising, as you can see from where my cursor is, to a point of 18,000 points. So the TSX was valued at 18,000 points on February 17th, 2021. Now the question here remains is, when the COVID hit, the market collapsed almost to 11,200 points on March the 23rd, 2020, approximately 11,000. So you see a huge fall from February the 17th to March the 28th, or 6,800 points, or 38% drop. Now, when a stock market falls like that, great fear and panic is being set, because they thought the COVID, when it shut down businesses and economies, the companies are not going to be able to produce the kind of profits that they used to pre-COVID time. Now, let's look at the recovery. Right? It came down to 11,200 points, and you see where the cursor is. It started moving backwards, upwards, mainly because they came up with very quickly, they came up with a vaccine. And although they spewed all kinds of craziness, like you can wear masks, triple masks, have vaccines, one one shot, two shot, three shots, booster, whatever, they spread the news that the vaccine would prevent you getting COVID, which subsequently has been proven that's not quite true. And so, but at that point in time, the market started rising. And January the 4th, 2021, the market hit 18,000 points. So you can see from this particular chart, within 1 year of where it hit 11,200 points, it recovered to pre-COVID levels on January the 14th. I'm sorry, January the 4th. See, February to January, 1 year, it rose again 6,800 points, or 61% upward, to hit the 18,000 point. And you can see that it continued to rise as you see my cursor, to a point where it hit a record on April the 4th, 2022, of 22,200 points. That was the high on April the 4th, 2022. So in 2 years, we had recovered all of those. Here's a point called A. It declined from that all the way down to 20,000, now 18,000 points, for many reasons, including the fear of inflation and the fear of interest rates. And then in B, it was within a range of 18,000 to 20,000, so increased by 19,600 points. Increased to, 19,600 points. So if you look at the whole TSX move from March the 23rd, the great collapse, to April the 4th, the TSX itself rose by 11,000 points, or almost 98% recovery, or not recovery, growth in that time frame. And one of the reasons, there are many reasons, but one of the reasons was the stimulus package and the vaccine that brought confidence to the economy, to the investors. Now we want to look at what are actually the economic growth drivers. What do I mean by economic growth? One of the things that we look at the economic growth will be the natural resources, right? Natural resources, well, for example, fertilizer for grains, right? Fertilizer for food. And you have other things like oil, gas, and infrastructure is also a very important thing. You saw the supply chain problems earlier, a couple of years ago, when there was a huge problem bringing goods and shipping goods to the western coast of Canada as well as the US. And then you have human resources, the ability of having skilled workers doing jobs that need to get done. And then you have deregulations, whether it doesn't have all kinds of rules. For example, in the US side, the rules that were introduced by the Biden presidency caused so much of rules and regulations that there was no more wells being built or dug in the US, creating a global supply shortage. And then you have taxes. If there's a reduction in taxes, it's an incentive for businesses to grow. And then you have innovation and technology, so that the production, or the cost of production, improves, and so on. What were the recent challenges? On the right-hand side, you will see the recent challenges. Obviously, you had the COVID pandemic, which was still causing trouble. You saw the shutdown in China. Then you have supply chain. We all know about those things. Globalization became a major problem. All right, factories that were built, that were created in China, had to supply the products to Canada or the U.S. For example, medical pills and tablets, which come from China to North America, became a problem. So as chips for cars and chips for things, battery-operated vehicles, and even the regular gas motor vehicles were all dependent on chips, where factories were built in Taiwan, and they couldn't get them to to the US. So now there's a shift away from globalization, saying we need to have nationalization to build factories here. Political problems, obviously, the chaos that took place in Britain, you can see, you realize that once there was a prime minister, then 6 weeks later she had to be replaced after the former prime minister was found guilty on many things. So there was a change. As there's a political change when Trump lost the elections and Biden took over and introduced new kinds of rules. Social changes, and you can see the chaos and lawlessness in the U.S. as democratic states try to loosen the regulations, no cash bail, and so on and so forth, creating lawlessness in many of the cities in North America, in the United States. And also we had big problems here when the convoy came to Ottawa, and now there's all kinds of investigation. The Prime Minister says that these guys were, terrorists and things like that, whereas they say all they wanted to do was have a meeting with Trudeau to discuss all those mandates that he was forcing them to have. So those are the problems that you see, and the question here is, how does the economic growth impact the stock market? And you look at the GDP growth. What is GDP? GDP is the total goods and services produced in 1 year. Gross domestic product is the method they use to calculate the goods and services produced within the country. So as you see from this, as the GDP grew, on your right hand side you will see the total market capitalization of companies, and you see the same sort of increase, the same trend line as the GDP. Now, what is market cap? Market capitalization is the value of the companies within the TSX, the companies that produce goods and services, that is the GDP, and the market capitalization. How much are you willing to pay? The individuals decide how much, or the institutions say, how much are you willing to pay for the shares of a company that you think will produce goods and services which will be profitable. Okay? So generally, you have to see, as the country's GDP grows, so will the market capitalization. Now we want to look at the forecast time period. I want to establish very clearly, we are not doing a 12-month forecast. What we are looking at is a 3 months, January, February, March. All right? As we look at the past performances and try to make an educated guess at what will transpire in the future, keep in mind the following. Number one, the forecast is only for 3 months. That is, it is a short-term forecast. Number two, it is possible that we may have more than a 60% accuracy rate. It is also possible we may not have more than a 60% accuracy rate. A close in-between accuracy rate is more likely. This is not carved in stone. Number five, we make adjustments as more information comes to light. On January the 25th or 26th, the Central Bank of Canada will introduce interest rates, so we have to make adjustments. But when we say when information comes to light, we're talking about the government's intentions or declaration of information such as interest rates, so that we can make adjustments to our forecast. Geopolitical events may be a game changer. Here is where the biggest problems arise in the States when the Republican-controlled Congress starts investigating Joe Biden and his family and all the other things that has come across, the Russian collusion and the raid on Trump's house and things like that. They may be global political changes, okay? Events in Europe, we have to see what's going on, as well as in Asia, in China, Japan, Korea, and Taiwan, primarily events that may cause or create a game changer. Now, what is the time period we are looking at? We said 3 months, keep that in mind. What are the main challenges for Canada? The main challenges, although we highlight a number of 12 points here, we are not going to go through all those 12 points. We're only going to examine a few of those challenges, all right? Inflation is one that we will look at. The consumer price index really gives you the inflation rate, the GDP growth rate, interest rate, chartered banks, prime lending rate, housing starts, unemployment, number 7, government gross debt to GDP, 8, manufacturing, PMI, 9, consumer confidence, 10, government revenues versus government spending, number 11, value of building permits, and number 12, disposable personal income. Now, throughout the year, we as a company, we will be giving our clients detailed information on those things that you've seen listed as information comes, and we adjust those things. Now, let's look at the COVID challenge. What is the COVID challenge, right? And you can look at where my cursor is. There was a COVID that came from China. The government lied about those COVID coming out of China, and so that infected the world's population. More than 124 countries had COVID. There were quarantines that were established. Factories were closed. Transport was not allowed. Global demand for oil declines. Obviously, when these things, when you're not allowed when you're not allowed to travel, you have restrictions on shipping because there are no goods being produced in factories or transport of factories within the countries, and so that was the main challenge. So let's look at what happened when the COVID hit, and we showed you an earlier chart of how the market dropped 11,000 points, and you see a global market sell-off. When that happened, when there was a global market sell-off, you saw the TSX sell-off, you saw the crude oil decline, energy stocks were hit, and then you see global supplies, Saudi Arabia and Russia oil versus US sales oil. And as soon as Biden came into power, he shut down the US shale, creating a tremendous energy stock sell-off. And but gold became important because people continue to think that gold has some kind of value in times of great turmoil within the countries. And you can see here a government intervention, interest rate cuts, stimulus packages, vaccine research, strict control, travel controls, buildings were quarantined. I mean, unfortunately, a lot of people have forgotten the great chaos that the COVID challenge created. Now, we want to look at inflation as part of the COVID challenge. COVID created a tremendous supply of government money being poured in. And if you look at the US, if you've been tracking the US, massive amount of monies were poured in, even in Canada. So when the economy was shut down because of COVID, there was an excess supply, which actually reduced inflation. But as the economy was opened, pent-up demand, and here is where inflation became. All right, this chart will help you if you're interested in looking at CRB, expenses, and so on. What were the probable causes? We looked at the economy shut down due to COVID, no demand as shops were closed, shops and factories. And then you had government programs. In Canada, we had the Emergency Response Benefit, or CERB, plus others. And here's an example. The federally funded Canada Emergency Wage Subsidy, or the CEWS program, had its final pay period in October the 23rd, 2021. The program provided more than $96 billion in wage subsidies to eligible Canadian businesses. That was the government input. The economy opened up, so there was great demand. The problem was supply, as you realize that things coming from Asia did not get into the Canada, and there was the problem. So you had pent-up demand, plus supply chain restrictions, plus government stimulus. You had inflation coming at a tremendous pace to us. Now, what are the causes? Inflation has a deep impact on the livelihood of people as the prices of all basic necessities increase with inflation. The prices of certain commodities increase with time, but whenever there is a huge increase in the prices of basic commodities within a lesser period of time, then it is under inflation. However, there is always a single reason for inflation that can be There's not always a single reason. There are many reasons for it. You have two types of inflation. The reason why I'm telling you this is you may be reading articles or seeing the stuff cost when they talk about cost push inflation. Really, it's when production costs rise and the producers pass the increase to consumers, right? So the inflation happens. That's called cost push. The demand pull inflation, where demand for goods increases and exceeds production capacity. This is what we have initially felt when there was a major supply chain restrictions, and that was demand. But we also have cost push inflation because the cost of products increased and we had the devaluation of our money. Price increases were seen for edible fats and oils, 26%, coffee and tea, 16.8%, eggs, 17%, cereal, 16%, bakery, and so on. So you can go to Stats Canada to see which area is causing the inflation if you want to, and that's a good thing because then you can look at the companies that produce those things, and either it's a good thing for the economy or bad, depending on how the data falls out. So let's look at inflation as it ran over between 2021 and 2022. And you see Canada's annual inflation rate was about 7% in November of 2022, and that's the range it's showing, between 7 and 8%. I personally don't agree with the 7% because that is a government stat. But if you went to your own supermarket or to the Home Depot or whatever, you will find that inflation rate is much higher. So what is causing the Canadian inflation? The contribution of U.S. core inflation peaked in the second half of 2022, but will continue to push upward, but diminishing pressure on Canadian inflation through 2023. The rise in the price of oil is also playing a role because it increases the cost of producing goods and services, and this was based on December 5th, 2020 Stats Canada, right? So here is where inflation used to be, and it went all the way up to 8. It's coming down a little bit, but we don't see that happening quickly. We continue to see inflation as a problem in the first quarter 2023. Now, what is the challenge? How does inflation affect economic growth? Inflation affects all aspects of the economy, from consumer spending, business investment, employment rates, to government programs, tax policies, and interest rates. Understanding inflation is crucial to investing because inflation can reduce the value of your investment returns. And we showed you earlier on that the cost of investing in a mutual fund is X%, and then you add inflation and it blows you off. So inflation will have less purchasing power and then less savings, loss of goods and services. In an inflationary environment, unevenly rising prices inevitably reduce the purchasing power of some consumers. And this erosion of real income is the single biggest cost of inflation. Inflation can also distort purchasing power over time for recipients and payers of fixed income, fixed interest rates. So if you are on fixed income, inflation is certainly going to have a tremendous impact on you. But even if you're a business person, interest rate loans, higher interest rate loans will not allow you to find solutions. Now, what is the solution to inflation? And if you look at the chart here, or at least the picture here, wherever inflation comes, the government tends to raise interest rates, saying that will cure inflation. Let me tell you, the Federal Reserve of the United States has never got it right. It's almost a proven fact that the Federal Reserve either underestimates the inflation pressure or overestimates, more likely overestimates, and brings the economy to a general halt and creating recession. So what do central banks raise? Why do they raise interest rates? Let's look at the briefly. Higher interest rates encourages savings and discourages borrowing and in turn spending. In response, companies increase their prices more slowly to encourage demand. This is supposedly to reduce inflation. The Bank of Canada raised the target for its overnight rate by 50 basis points to 4.25% in the last meeting of December 7th, 2022, in line with market expectations and pushing borrowing costs to its highest since 2008. Policymakers added that they were continuing this policy of quantitative tightening. Policymakers noted that economic growth remains strong, although it is expected to stall through the end of the year and the first half of 2023. Also, the labor market remains tight, while inflation is still too high and short-term inflation expectations remain elevated. Looking ahead, the central bank will be considering whether the policy interest rate needs to rise further to bring supply and demand back into balance and reduce inflation to a to a target, in a sign the tightening campaign could be near an end. The central bank raised its rates at a record pace of 400 basis points since March 2022. And we want to look, this is the philosophy of the central bank, that by raising interest rates, they can hold inflation down. Let's look at the interest rates between February 2022 and December, and you can see from just 2%, below 1% in February, is jumped to 4% in December. And the upcoming meetings that you should make note of, on January the 25th, the Bank of Canada Monetary Policy Report. You must pay attention to that. And then again in March, they have a rate decision. So mark those things in your calendar, January 25th and March the 8th, all right, so that you are aware that the central government will come up with something. Now let's look at inflation versus interest rates. And here, December 2020 and December 2022, 2 years, okay? And you see from January, the Canada inflation rate is the blue, and you see there was no move until April, and then it started moving up to 8. And then you have the Canada inflation rate also trending up and slowly coming down. So they are saying that based on the interest rate hikes, inflation comes down. Now, what do you do when you compare interest rate hikes with the Canadian dollar exchange rate? The short-term Canadian benchmark for bond 2-year deal is shown by the red, and then the U.S. benchmark U.S. 2-year is shown by the yellow, and the exchange rate is shown there. And here we have the problem of U.S. federal funds rate versus the Canadian interest rate. Remember, Canada cannot do anything beyond its dependence on the U.S. government's Federal Reserve rate, right? The U.S., you've got to remember, the U.S. is a huge, huge economy, global largest economy, and we are moved by what they do. So interest rates are much dependent on what the U.S. does. Let's look at it from a perspective, inflation in perspective. The headline inflation, that is what the government shows you, the current rate is about 7%, and then between 1971 and 1976, it was 12.7%. 1977 to 83 peaked at 12.9%. And the biggest chunk was obviously gasoline. We have almost 40% here contributed by gasoline, and then transport 11 point. So it's a huge position as it was historically, and then you can see that 45% in 77, 83, and 20% was transport. And then you had food, another major player, not so much now, but it was 18% and 20% previously, as with owner accommodation and rent, right? So those are main contributors, and the biggest one is gasoline. So we need to pay attention to the price of oil. What's the problem with the price of oil? And you see on June the 8th, 2022, it hit $106.51, right? A massive increase, and this is December 23rd, where my cursor is, 2022, and you saw that rise, and then it dropped almost $36 all the way down to $80 primarily to the COVID lockdowns, the EU ban on Russian oil, and the G7 price cap on Russian oil. So those type of rules that they came out with against Russia, which indirectly impacts OPEC plus, and that's what the problem is right now. So oil is sitting at about $80 at the time of broadcast. Now the forecast seems to be anywhere between $80 here and moving on to between 140, 120. Crude oil is expected to trade at 77 US dollars per barrel by the end of this quarter, according to the Trading Economics Global Macro Models and Analyst Expectations. Looking forward, it is estimated to be around $86, $87 in 12 months' time. Now, it is very, very hard to forecast accurately the price of oil because it depends on a number of things. And the points to note here, you see the global challenge: A, inflation; B, supply chain problems. We talked about the war, Russia, Ukraine, Israel, Iran, China, Taiwan, North Korea. Interest rate, central banks hikes may lead to recession in third world countries as the US dollar rise in values. What does this mean? This means when the World Bank lends money or the IMF lends money, it's all in US dollars. And the third world countries have to pay back in US dollars. When the US dollars appreciate, then they have to take the money away from their domestic aspirations. For example, if they're going to build a port, they can't fund that port, so because of the interest rates, they have to pay higher loans back to the US, back to the IMF. And then the US economy, there's a battle between Democrats and Republicans, and this could cause a recession. Europe, oil shortages, we talked about that, and food inflation creates greater migration challenges, right? And for the suggestions on oil stock purchases, well, we have to do it for the clients on the RTMA sessions. Now, Bank of Canada, this is what they're saying, and we can go through this whole thing, and you can stop this video and read this detail for yourself. But I just want to highlight to you the ones in red. Considering whether the policy interest rate needs to rise further to bring supply and demand back into inflation target. So the government is saying that it wants the inflation to be about 2%, or at the high end maybe 3%, but that's one of the biggest challenge that the country faces. Now, this is what we, as an investor, you have to be cautious. Where my cursor is showing you on the chart here, CPI excluding food and energy is 4.5%. You cannot look at inflation excluding energy and food. That's crazy. Okay, that's critical to every investor or individual buying food and energy. Now, let's look at the interest rate forecast. And while you can read this in detail for yourself, I want you to look at this chart. This is what they are forecasting. Households will spend more on debt payments on months ahead. Debt servicing is a percentage of disposable income right there. Okay, that's a major cost, 15%. When you have to pay 15% of your income to maintaining your debt, or either it's credit card, mortgage, car financing, things like that, that is a major restriction to consumer spending. All right, let's look at housing. And if you look at housing, in Canada, housing is very important. The Canadian housing starts remained elevated in November. Housing starts came at 264 analyzed units in November. Single detached homes declined 7%. Alberta was the biggest loser, and then Quebec and Saskatchewan. The Atlantic regions were roughly okay, 7.3 K to 12.5 K units. And then here's the implications. Housing starts continue to run at highly elevated levels, that is well above the pre-pandemic run rate. Home building is being buoyed by low levels with unsold inventories, still elevated prices, and robust gains in sales made during prior years. Moving forward, we are forecasting a steady drop in the price of housing simply because of interest rates on bank loans. So those are the challenges: consumer spending, mortgage payments, banks, housing costs is impacted on that. Looking forward at retail sales, again, retail sales, consumer spending and retail sales both declined in the third quarter, pulled lower by weak spending on goods. Today's retail sales report suggests consumers are somewhat cautious in November, with spending flat in real terms. Higher rates will be the cause of the homes being not being able to spend on products and things that they want. And the chart here shows you very clearly what is in January 2022. That's 3.6%. In December, it's or late November, it's 1.4 negative earlier on. So that's another problem. Manufacturing jobs also causes a great tension, and you can see the decline in manufacturing jobs as people decide not to work for two reasons. One, that they find that they're not skilled to do those jobs. Secondly, they receive more money from the government than from what they have to in terms of working. Canada, while the U.S. has experienced a resurgence of reshoring in manufacturing activity through the pandemic, Canada has not benefited to the same degree. And that's one of the problems in Canada. The most obvious inroads in the transportation space. If North America is to become a meaningful global player in the production of electric vehicles, establishing domestic sub-battery is very important. That's, there's another battle here. All the requirements, lithium requirements, are found in Ukraine and Africa, and that's a major challenge in terms of mining that. Now, looking at the forecast for first quarter, there's rarely a straight line between uncertainty and market outcomes. So you can't really produce 100% accuracy. 2023 will usher in the next phase of economic cycle that fully manifests in the past action of central banks. So very important what central banks do. Consumer resilience will be tested under the weight of declining real incomes, higher debt service, and thinning savings. Right? Real incomes are going to decline. Business will likely show less enthusiasm for competing for new workers. Right? They don't want to increase their wage burdens. During the early turning points of business cycles, investors fret over depth and duration of economic weaknesses. Most businesses are forecasting and saying, hey, what shall I do? Will there be a recession? Should I expand? Should I contract? Things like that. And this usually creates volatility and can drive drive investors backwards, the safety of US dollar until some assurance the worst is over. We're talking about the US dollar. I mean, as soon as there's concern in the global market, you either go into US dollars when interest rates are high, you get a big return, or if the US dollar is weak, then you go to gold. That's where it's been all this while. In other words, investor sentiment in the first half of 2023 will be rolling up and down. So volatility is what our forecast is in the first quarter. And the Bank of Canada interest rate forecast on December 7th, it raised its rate from 3.75% to 4.25%. This 50 basis point increase imposed by the Bank of Canada has caused Canada prime rate to increase from 5.95% to 6.5%. Imagine a jump in your mortgage loans. That will be quite difficult. So here are the BOC or Bank of Canada meetings for 2023. I told you about January 25th and March, so you can continue to track these events. Crude oil will be in Republican hands, and there'll be a great urgency to have American oil drilled. Tremendous economic growth and more jobs in the energy sector. This will boost the Canadian sector if the Congress can get approval and get it done against a Senate which is Democrat and a President which is Democrat. China and Southeast Asia will not care about. China has decided forget about the COVID challenges. We want to grow the economy, and they want to become the superpower overtaking USA and China. Remember, China really doesn't care who dies, right? They are a communist nation. They have no real concern about human life, and so they will let whatever they have to do to get economic growth. Now, supply restrictions you will face, of course. OPEC will try to keep the price at around $80, and this will curb supply if U.S. oil comes on stream. Highly unlikely that U.S. oil is going to come on stream, but the average $80 rate is what the OPEC countries want, because many of their population receives all kinds of benefits and they need to be kept happy. War, we talked about Israel and Iran via the Hormuz Straits, the escalation of Russia's Ukraine situation, and possible China's expansion into Iran. Those are things that caused. And you can look at this chart, and here we put together what causes oil prices to move up and down. Now, for our client base, they don't have to worry about this, because we tell them what it is that they need to track. A little background about what we do. Train to Invest was established in 2004. We are basically a company that achieves this through teaching, training, and coaching individuals in the art and science of self-directed investing, with foundation based on capital preservation. So you can go to our website, www.train2invest.com, and get a free ebook, The Stock Market, The Untold Story. It's a very important, a very interesting package we put together, so that your mind or your thinking will be expanded, because the financial services industry doesn't tell you these things. Now, I'll give you an example of a junior's account, and you can see here this is from October 2022 to November 25th, 2022. Junior's account increased by 12.31%. That is a 22-year-old dyslexic student who turned $2,000 to $5,000 in 2.5 years. Okay, that is just amazing of what he has done. Here's a question: the evidence demands a verdict. What did your financial guru do for you? Were you able to get 12% a month, or even 3 or 4% a month on a compounded basis? Will be just phenomenal. Let us give you a testimonial here. And here in August the 13th, we have a gentleman with a TFSA account, and he says, just to let you know that my account grew 33% year to date. I must say I'm somewhat skeptical when your team drew up the portfolio strategy for me. My financial planner said this will never work. I believed in him for so long. My money started disappearing in value, yet I paid this terrible amount in fees. I really wish I had listened to my friend who recommended the course in 2017. Thank you very much. I will let my friends know. These are the types of testimonials we receive quite often. You can go to our website and look at this testimonial section, and you will see those things. Now let's talk about technical indicators. Now here's Royal Bank. Royal Bank is Canada's largest bank measured by assets, 1.5 trillion, market capitalization 130 billion, and one of America's leading diversified financial companies. Net income 12.5 billion. Okay, just think about that. Net income 12.3 billion. Compare that to your amount you have in savings or investments. A bit different, right? Royal Bank said its earnings released that going forward it will pay a quarterly dividend of $1.32, 32 cents per share. So if you have $100 shares, you're going to get $1.32 for every share, 4 cents or 3%. HSB Holdings, HSB wholly owned subsidiary HSB Overseas Holdings UK, has entered into agreement to sell its Canadian banking business, which is called HSB Canada, to Royal Bank for $13.5 billion. Right? Now this will open a huge, a huge market for Royal Bank, because HSB, Hong Kong Shanghai Bank Corporation, now based in London, used to be based in Hong Kong, and it has an extensive network for Asian business. So suddenly you see the Royal Bank having a major move into the Asian market. Now let's just say, for example, you bought a Royal Bank on June the 6th in 2020, okay, for $89.50. And then on January the 17th, 2022, you sold it at $149, right? What was the reasons for buy and sell will be technical indicators, like this type of MACD lines. Don't worry about that. We'll teach you that. And fundamental analysis. The green dots here are what we call dividend paid. Every quarter you got $1.08 per share per quarter, right? We told you that the quarterly dividend is going to rise to 132. So it used to be 108. You sold it out here. So your sell price was 149.50. Your buy price at 89.50. You gained $60. So you made a profit of $60 per share on that particular transaction. And then if you add the dividend income that you got, all those green things, it was another $7.68. Your total gain was 67.68 cents per share, or 76% gain. And here is an example of what many of our clients do. They bought shares at 44, the buy 44,750. They only bought 500 shares and sold it at 74,750 to make $30,000 in profit. And then dividends on 500 shares, you got 3,000 additional. So you had an income, at least a gain of 33,840 within 2 years, or 76%. That is a phenomenal return. What is your risk? Royal Bank is the largest bank in Canada, and so your risk is somewhat limited. If Royal Bank collapsed and closed shop, Canada itself will be worth diddly. Okay? So what for a novice investor, do not panic over all this information that I'm giving you. All these things are teachable, and we will walk you through. Stock investing can be challenging, but with the right knowledge, strategy, and discipline, it can be a powerful tool for building wealth. By taking the time to educate yourself, develop a clear investment plan, and diversify your portfolio, you can set up yourself for success in the stock market. And we can show you what we mean by what's going to happen in the first quarter 2023. Right? The global economy is not at imminent risk of sliding into recession. So we're not going to see recession happening in January, February, March. That's for sure. As a sharp decline in inflation helps economic growth. But a U.S. recession is likely before 2024. By the end of the year of 2024, you may see some form of recession somewhere, depending on government strategy. In the first half of 2023, the S&P 500 is expected to retest the lows of 2022, but a pivot from the Federal Reserve could drive asset recovery later in the year, pushing the TSX to 4,200. Right now, in January of 2023, it is 3,800. So 400 points increase is very, very good for investors. Let me give you an example of an updated testimony that just came in just very recently. In fact, it came on December 30th, right? Not sure if you're checking email. I wanted to send this out to you today, as my wife and I are going away to Hawaii on the 2nd and won't be back until March 31st. Well, what can I say? What a journey this year has been. My TFSA grew 22.3%. My cash account grew up 45%. Nobody can believe that. I made sure that I signed up my 4 adult children last week. As said, it is like giving a Ferrari to a 16-year-old. It is the same as giving your inheritance with no tools. I cannot thank you and your team. I've been receiving unbelievable emails for more than 2 years before signing. I just was stubborn and somewhat tight. All right. So that's the type. I told you we received many testimonials, and the next part or the next session will be for our clients, which is called the real-time market analysis, where we talk about stock analysis, specific analysis, and building an RRSP TSA portfolio, preparing for the fourth quarter and first quarter 2024. So thank you very much for listening. You can go to our YouTube channel and look at the various YouTubes we have posted, and also keep us on track with the Facebook. We ask you to go to our website. If you have any questions, you can find answers within our website, Or if you want to just talk to us directly, send us an email at admin@traintoinvest.com or give us a call at 204-414-9106. Thank you very much and have a great year in trading.